Welcome back to Investing Talk Podcast.
Today we're looking at AST SpaceMobile.
As usual, before we start, subscribe, like, and comment to this video to support the show.
And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis.
Yeah, let's. I think when we look at this company, you have to remember that for years it was basically just a research and development venture.
Purely R&D.
Exactly.
Yeah.
But that era is, well, it's definitively over. The Q3 2025 results, they marked a really clear financial inflection point. It demands a closer look.
Okay, let's unpack that commercial transition.
Yeah.
Because the numbers they're pretty stark.
They really are.
That Q3 revenue, it came in at what, $14.7 million?
Roughly, yeah.
To put that in perspective for everyone, that is a 12-fold surge over the $1.1 million they reported just a year ago.
A year ago. It's incredible. And even sequentially, from Q2, it was a huge jump from about $2 million.
So this isn't some fluke. This is the sound of the commercial engine starting to turn over.
That's a great way to put it. It's mainly driven by gateway equipment sales and some of that initial service revenue finally coming online.
And it seems like management is backing that up, right? They're not getting shy about it.
Not at all. They reiterated a really strong projection for the second half of 2025. They're guiding for between $50 and $75 million in total.
$75 million. So to hit that, to even get close to the upper end of that, Q4 has to be massive.
A massive acceleration. It means they have to execute flawlessly on some big contractual milestones.
And what I found really fascinating were the unit economics.
Yeah.
For a company that's in this insane capital-intensive phase.
Right, you'd expect the losses to be ballooning.
Exactly. But the loss per share in Q3 was negative 45 cents. That's almost half the loss from the year before.
Which was over $1. That's operating leverage. That's the first hint of it, which is pretty rare to see this early in the game.
That's a crucial point. So once that satellite is up there, that's the fixed cost.
That's the huge fixed cost. After that, adding 1 million new subscribers, it costs them almost nothing extra.
So as the revenue ramps, the profit should, in theory, scale non-linearly.
That's the whole model.
Yeah.
But, true long-term visibility, that comes from the pipeline, not just 1 or 2 quarters.
And their pipeline visibility seems, well, frankly, exceptional for a company at this stage.
It really is.
They're sitting on commitments over $1 billion. $1 billion.
In contracted revenue. That backlog gives you that multi-year visibility as the constellation gets deployed.
But these aren't just, flimsy promises or MOUs, are they?
Far from it. That $1 billion figure, it includes hard strategic money, specifically a massive $175 million prepayment from the Suite Group for future services.
A prepayment. So they're handing over cash years before the service is even fully delivered.
Yes. And when a Tier 1 mobile operator does that, it's arguably the biggest vote of confidence you can possibly get.
It just completely de-risks that whole commercial pathway.
It does. And that leads us right into the core thesis here, which is the technological moat.
Okay, so in this really crowded field of space connectivity, what makes this company different?
It all comes down to one thing: direct-to-cellular broadband, using unmodified standard phones.
The phone in your pocket right now.
And one right in your pocket. No special dish, no clunky satellite phone. Most competitors, they either need special hardware or they're just offering, basic text messaging.
So AST SpaceMobile is trying to be the cell tower in space.
That's their entire pitch.
But why is that so hard? Why does everyone else need special gear?
It's physics. It's a problem called path loss. A normal phone antenna is tiny. It's designed to talk to a tower a few miles away, not a satellite hundreds of miles up.
So the signal just isn't strong enough.
Not even close. So to overcome that, you need these physically gigantic satellites with massive phased array antennas.
So that huge surface area we see in the pictures, that's not for show. It's a physical necessity to catch and focus that much signal.
Exactly. It's about generating extremely powerful and directional beams. It's a very, very complex breakthrough, and they've leveraged that into an equally important moat.
The partnerships and the spectrum.
That's it. Let's focus on the partnerships, because that's almost impossible to replicate. They have definitive commercial agreements with Tier 1 operators all over the world.
We're talking about Verizon, Vodafone, Suite Group.
Giants. Together they represent billions of subscribers.
So this is their distribution network.
It's their distribution and their regulatory advantage. Those partners give them access to licensed L and S-band spectrum. You can't offer this service globally without it.
And getting that spectrum requires deals with the existing carriers in every single country.
Every jurisdiction. So
Yeah.
they aren't trying to compete with Verizon. They're trying to help Verizon fill its coverage gaps.
So it's a win-win. The mobile network operator gets 100% coverage without building more towers.
And AST SpaceMobile gets a guaranteed revenue stream. And now they're scaling up their supply chain like crazy to meet that demand.
With the new facilities in Texas and Florida.
Mm-hmm. And that vertical integration brings us back to their costs. Management is guiding that the average capital cost per satellite, including launch, will be around $21 to $23 million.
Which, in the space sector, is remarkably efficient.
And that guides us to the third big theme, financial health, liquidity. Can they afford to build this thing?
Well, they've certainly been proactive about it. Thanks to all those convertible note offerings in 2025, their cash position is now in the multi-billion-dollar range.
Right. Reports put it somewhere around, what, $3.2 billion? It gives them a runway well past 2026.
Which is critical. But it's not just how much they raised, it's how they structured it, right?
Actually, they made two really smart moves recently. First, they used an equity offering to buy back $50 million of existing convertible notes.
So they're wiping out future interest expense, cleaning up the balance sheet while raising long-term cash.
Precisely. And at the same time, they did a huge $1 billion private offering of new convertible notes, pushing the maturity date way out to 2036.
2036.
Okay. But the really fascinating part is the conversion price on those new notes.
Which is what, around $96 a share?
$96.30. And that number is, it's just staggering when you look at where the stock has been trading.
So what does that tell you?
It tells you what sophisticated credit investors, the most risk-averse people in the market, think this stock could be worth in a decade.
They're essentially betting the company will be a massive long-term winner.
They only make real money on the deal if the equity justifies a $96 valuation by 2036. It's a huge signal of institutional confidence.
But let's pause there. Doesn't that 2036 date also tell you that full profitability is still a decade away? Why should an equity investor wait that long?
And that right there is the elephant in the room. Free cash flow.
Which is?
Deeply, deeply negative. Capital expenditures were around $259 million in Q3 alone, and they're guided to be even higher in Q4.
So the argument from the bulls is that this is necessary. It's front-loaded CapEx to build the network.
Right. You have to spend massively now for massive low marginal cost revenue later. But that profile is the definition of high risk, high reward.
Which guarantees volatility. So for you, the investor, let's look at what could go wrong and what could go right.
Starting with the risks. Number one is always execution. I mean, building and launching a constellation of satellites this complex
is one of the hardest engineering tasks humans can do.
Absolutely. And we saw a little hint of that risk when their Q3 earnings actually missed consensus forecasts.
Even though the growth was huge, the miss itself can spook the market.
It can. And any delay in the schedule, any problem with a launch or with integrating the software with the carriers, that just pushes revenue out and burns more cash.
And we also have to talk about dilution. The financing was great, but it did cause the stock to drop initially.
It did. And you have to be aware that if execution lags, they might need more financing down the road, which could mean more dilution.
Okay, so those are the headwinds. What about the near-term catalysts, the upside?
The most immediate high-visibility event is the launch of Bluebird 6. The satellite is built, it's tested, and it's being transported to the launch site as we speak.
And that news alone sent the stock surging in after hours. People get it. The launch is the ultimate validation.
It changes the story from we can build it to we are building it. And on top of that, you're seeing bullish signals from the inside.
The insider buy.
Yeah, a director, Keith Larson, made an open market purchase of shares in December. This isn't a stock grant, this is his own cash.
And buying shares during a period of high volatility and financing, that signals a lot of confidence in the immediate milestones.
It's a very positive sign. And that combination, the concrete milestone of launch and the insider confidence, that's what the market is going to be focused on for the next 6 months.
So if we step back and connect this to the bigger picture for you, this company is navigating its most critical phase.
They're proving the tech is scalable, that the business model is financeable, and that the biggest carriers in the world want their service. They have the cash, they have the partnerships, and they have the technological lead.
And the market seems to be rewarding that progress. The core question for you, the investor, is really this. Are you willing to underwrite that short-term execution risk and the volatility that comes with it?
in exchange for owning what could be a category-defining piece of global communications infrastructure. The potential payoff is framed by that incredible $96 conversion price. The prize is substantial if they can keep this up.
Don't forget to subscribe, like, and comment to support the show. And make sure you're following us so you don't miss our next analysis.